not get the pink memo this morning. TK did. Pink bow tie, leopard print shoes, should have seen it. Brutal. Equity futures right now on the S&P 500, positive 0.4%, up on the session, up on the week. The Nasdaq yesterday struggling. Netflix, Tesla, taking a bite out of the rally so far year to date. Just a small one. Biggest one-day drop. Going back to February on the Nasdaq, a lift into the opening bow. There's the opening bow. Switch at the board and get to the bond market. Yields look like this on Treasuries, down 3 basis points on a 10-year to 3.82. Yields up yesterday off the back of a downside surprise on jobless claims. In the FX market, heading for the biggest weekly loss going back to May on the euro against the dollar. Having a look at 113 earlier in the week and now backing away to 111.30, unchanged on the session. Crude up by 0.8%. WTI $76.30. We're up there by about 65 cents on the session so far. In the session at the moment, about 30 seconds in, we are positive by 1/3 on the S&P. On the Nasdaq, we're up by about 0.6%. One mover to take a look at, American Express. Shares under pressure after delivering disappointing revenue numbers. The CFO saying spending levels are, quote, more stable now following the post-pandemic boom. Abby has more. Morning, Abby.
Good morning, John. And lots of nuance here to this American Express quarter. And the stock is down just moments ago, the worst day in more than 2 months. Now, I misspoke earlier. They actually beat earnings relative to consensus. It was the BI estimate that they missed, and that's on increased lower expenses than expected. But revenue, yes, it's interesting. They missed the growth estimates, but what makes it so nuanced, they actually put up record volumes of $426.6 billion, but that missed the estimate, so you know how it goes. Investors are a little bit disappointed, but the company talking about the idea that despite this, I would think that this would maybe point to some kind of consumer spending slowdown. They're not saying that at all, that the consumer spending is still, quote unquote, really strong. So it's going to be interesting to see how this stock plays out. Again, lots of mixed messages here. Right now, the stock is down 3.7%, down closer to 4%. So the bears are taking it at this moment, John.
Abby, thank you. Allow me to draw your attention just to a headline, just quickly. The former President Donald Trump, the classified documents trial has been set. The date has been set for May 20th, 2024. What we're going to do now is get Anne-Marie down in Washington, D.C. When she gets to the camera, we'll have a chat to her about that. But that's the headline that's just come across, that the classified documents trial for the former president, the date has been set for May 20th, 2024. AMH coming up very shortly. Allow me to turn to the financials. The regional banks this morning, more earnings results coming from Regions Financial and Comerica, both seeing jumps in net interest income despite concerns about credit contractions. Let's get to Shanali for more. Hey, Shanali.
John, if you take a look at this week, the regionals are really coming out clean, pretty much. You're seeing deposit pressure still at the banks, but you do have net interest income coming in pretty strong here. Jumps from a year ago and above expectations. Now, that's not across every bank, but it's certainly across these two regions and Comerica. Also, for these two banks, that is even including pressure on net interest margins, a little bit below expectations in some regards. But importantly, provisions for loan losses have been better than what Wall Street estimated. So that means that they're both making money and credit standards are still holding up. Now, the hope is that this follows through the season, but the KBW Bank Index certainly has had quite the rise this week with a lot of these fears easing. Some analysts take Mike Mayo feeling like the worst is certainly behind us. Though profitability pressures still exist, it's nothing to cry home about after the sell-offs we've seen this year.
3 months ago feels like a lifetime ago, and I guess that's good news for many of these banks. Shanali, thank you. Let's stick with the earnings. CSX shares falling after the rail freight company reported Q2 revenue that missed estimates. The CEO writing this, activity remains challenged. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, CSX shares currently off more than 5% after those results. So let's get specific here. EPS came in at 49 cents, which was actually in line with estimates, but you had revenue and operating income come in lighter than expected. Now, the company said that it was lower fuel and coal prices combined with weaker shipping volumes that dragged sales lower. And like you said, the CEO himself saying that this activity is going to remain challenged. So Wall Street was actually fairly downbeat on these results. You had Citi and Susquehanna, both of those banks, cutting their price targets on CSX. And Citi in particular still has a buy rating on CSX, but it said that these results are, quote, they did not live up to expectations and that the volume outlook remains uncertain. And once again, you can see that in the shares this morning, currently off by more than 4%.
Katie, thank you. Katie mentioning a couple of houses, banks, brokers with some views on this name. Here's another one on CSX and the rails. Morgan Stanley warning the markets could overreact to its modest earnings miss. Here's the quote: CSX was expected to be the only rail that could beat this quarter, so the miss may really disappoint. Let's go from the railroads to the autos. AutoNation topping earnings estimates. The CEO saying the strong performance during the quarter reflects the continued resiliency of our operations and the benefits of our diversified model. Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, shares up, down all around in pre-market trading, but settling decidedly lower, down nearly 6% in trading this morning. This despite the fact that it did beat adjusted earnings per share pretty handily, $6.29 a share, topping the $5.89 that analysts had expected. But this was 20 cents lower in terms of earnings than last year. We're seeing a decided shift towards newer cars. This as used car sales falling, new vehicle revenue growth up 12%. So it's still making money, even though car values are a little bit lower. But we're clearly coming back to earth after that excitement during the pandemic. You know, one cause for caution here, and maybe why we're getting a little bit more negative response in the market today, is the gross profit on those new vehicles falling under $5,000 per vehicle for the first time since Q3 2021. Used car profit also falling. That said, on the positive side, you know, shares up more than 50% so far this year, so maybe just an end to that rally today.
Stock is down 5.6%. Simone, thanks for that. The latest there on AutoNation. The broader market at the moment positive by 0.4% on the S&P, on the Nasdaq up by 0.75% currently after a big first half of gains. Stifel's Barry Bannister expecting the equity market rally to start stalling out.
Everything is a rental now. Everything is a trade. If you think back to 2022, utilities, energy, they were great. Then they were terrible in the first half. Tech was terrible last year. This year it was great in the first half. The cyclicals, the banks, they were terrible in the first half. Now they're going to be good. You know, you really can't get too far ahead of yourself and over your skis when you're investing in this kind of a market. I think we're a few percent overvalued. I do think we end the year around 4,400 on the S&P 500.
Bannister reiterating Stifel's 4,400 price target for the S&P this year. This coming as Wall Street continues chasing the rally, with roughly half the survey strategists raising their year-end forecast already this year. Keith Lerner joins us now for more. Keith, you can feel it. People starting to chase it. What are you advising your clients should do?
Yeah, well, great to be with you, John. So what we did actually, you know, we came into the year a bit more on the defensive side. When we broke above 4,200, we upgraded our view on equities to neutral. We also did it back in early June in the equal weight S&P. I know you just talked about it. It seems like everyone's talking about the equal weight S&P, the average stock, which has lagged. We still think there's a little bit more juice in that overall trade, but from a big picture right now, we're strongly neutral, right? Strongly neutral against stocks, bonds, and cash. There's a lot of cross currents. This post-pandemic cycle is challenging the traditional playbook, and we're respecting the underlying trend. We don't think this is a runaway bull market. You know how you have a forward PE around 19.6, and we're going to hear from the three central banks next week as well.
Keith, I'm with you. This is so hard to read. I was reading your note, and you're dead on. Mortgage rates are at something like 7%, and the home builders have ripped all year. Makes sense of that. Manufacturing's in recession, unemployment's still at 3.5% because services are robust and discretionary spending through the roof on things like airfares and taking cruises. Keith, how on earth do you make sense of where we are currently?
Well, I think because this post-pandemic period, I think that the stimulus, which is still, coming through with the infrastructure bill, the CHIPS bill, has been underestimated. As much as how big it was, people thought it was done and there's no lingering impact. I think that fiscal impulse has been stronger. And I think on the other side, Jonathan, a year ago, if you and I were talking and we said the Fed funds was going to go from 0 to 5%, you said, Keith, what do you think about the economy? I don't think we would be arguing whether we would be in recession. We would be saying how deep. And what's been the biggest surprise is how resilient the economy has been. And the economy has been somewhat less interest rate sensitive, partly because of those locked-in mortgages, partly because of corporations have termed out debt. But, that's the surprise. So I think at this point you have these cross currents. I don't think this is a fat pitch as far as where the market is. A lot of the gains recently is repositioning. So I think you stay close to your long-term targets and be more patient to go either on defense or offense, later on in the year. But just right now, I think somewhere in the middle makes sense based on those cross currents.
And Keith, you're right. 12 months ago, it wasn't about whether we'd have a recession. It was about how deep it might be. You know what the conversation at the start of the year sounded like when equities started to rip and tech started to dominate? It was just bear market rally, bear market rally. And here we are 6 months later, 7 months later, and I still hear some people saying this is a bear market rally. Keith, who's to say this isn't the start of a runaway bull market like 09, like 20? Why isn't it that?
Yeah, listen, it could be, but I think our base case is it's not. And I'll tell you why, Jonathan. So when I think about the beginning of big bull markets, you have one depressed sentiment. So I think we can agree that sentiment was very depressed coming into this year and over at those October lows. You also bottomed last October when inflation, had spiked to the highest level in decades. So that's great, but starting valuations today at 19.6 multiple for the S&P. That's the highest valuation outside of that pandemic overshoot that we've seen for the last 20 or 30 years. So starting points are much higher. And then what's really important is that policy from the fiscal and monetary side going forward will be constrained. What tends to really support those big, long, sustained bull markets is liquidity coming into the market. Jonathan, I don't see liquidity coming into this market in any big way, in the near term or even over the next year.
A week ago on this program, Mohamed El-Erian turned around and he said, this is a soft landing narrative that you do not want to fight. I've heard others say we're in this sweet spot that could last a few weeks, last a number of months. Keith, do you not subscribe to that at all, that the data over the next couple of months is going to support this idea? Whether it happens or not, people will believe it because we're going to see more disinflation, more robust labour market prints, and people will get on board with this soft landing theme.
Well, I think that's probably already what we've been seeing. That's one of the reasons why we upgraded equities, seeing that the positioning was offsides, which already is starting to be covered, and we're going to see disinflationary trends in the summer months as well. And again, the market was caught offsides. As we get into the fall, I think as you think about base effects on inflation, maybe we get a little bit more stickier there and it becomes a little bit more problematic. And also as you move in a little later in August and September, historically that's when the volatility index starts to move up. And there's probably something that 3 months from now, Jonathan, that we don't know that's coming. We're going to be talking about that will change the narrative as well. So listen, at this point, we're respecting the underlying trend. We moved our equities within equities. We're staying with the U.S. We're still Team USA. We're focused on large cap. And I would also say we see some value here in the 10-year, at 3.8%, even a little bit longer duration, just to hedge portfolios to some of these cross currents that I've talked about.
Andrew Balls of PIMCO said the same thing 40 minutes ago. Keith, one more question, then I've got to get to my colleague down in Washington, D.C. But if you had a pick right now, if I could give you something up front, would it be the Fed decision and news conference with Chairman Powell or tech earnings and those results next week?
I will say tech earnings. Tech earnings are important. I mean, you look at the market this year, the technology sector is up over 40%. We all know the story about how much they've driven the gains. So tech earnings are going to be, very important as far as holding up this market and what's happening, what's happening next. Our baseline view, though, we upgraded tech in March. We think we're in a resting period. We still think tech is leadership. I don't have a big call about this earnings season per se, but if the economy does slow down later in the year, as we expect, I think companies are going to have to continue to invest in technology regardless, and that should support better earnings from tech relative to the broader market.
Okay. Keith, thank you, sir. Keith Lerner there of Truist. Your equity market at the moment positive on the S&P. Some breaking news just moments ago. Let's get down to Washington and catch up with Bloomberg's Kelly Lyons. Hey, Kaylee.
Hey, John, we now have the date for the trial of former President Donald Trump related to that classified documents case for which he is facing 37 counts of 7 different federal charges that he, of course, has pleaded not guilty to. May 20th, 2024. And in theory, John, this is probably not great news for either the defense or the prosecution. Prosecutors at the Justice Department had wanted to try this case this coming December, while former President Trump had bid for it to happen after the 2024 election because, of course, he is seeking the Republican nomination, which makes this timing, John, incredibly interesting because in May 2024, we will be post the Republican presidential primaries, but before the convention that is taking place in the summer. So potentially a very politically sensitive time for the former president. And he could be dealing with a number of other legal challenges at that time as well. As we know, he hasn't just faced this federal indictment. He already was indicted in New York on state charges earlier this spring. He could be facing down another potential federal indictment from Jack Smith, the special prosecutor who brought this case. President Trump himself said he received a letter from Jack Smith just days ago saying that he is a target of an investigation related to January 6th and efforts to overturn the 2020 election. He is also facing potentially an indictment in August in Fulton County, Georgia, also related to the 2020 election. So the litany of legal challenges really stacking up for the former president. And again, he will be going to trial in Florida on May 20th of next year, John.
Katie, thank you. It's on the calendar in bright red. There we go. That headline just crossing. Katie Lyons, May 20th, 2024. We'll turn to that a little bit later on Bloomberg TV and on Bloomberg Radio. Balance of Power later on this evening, 5 p.m. Eastern Time with Katie, Anne-Marie and Joe Matthew. Coming up, preparing for another big week of tech earnings and for big tech and the Nasdaq's rebalancing.
Some of these names are in the Magnificent Seven, and they were easy to jump onto when the market was going up straight almost for 3 months in a row. The healthiest thing would be that if money started to flow into other areas of the market and broaden.
That conversation coming up next.
earnings the next couple of weeks are going to be so important, right? These companies' valuations expanded, sentiment's quite high, and not only do they need to hit their numbers, they really need to satisfy the sentiment, right? And they need to keep the animal spirits going in those stocks. So you could have a situation where they nail the number and the guidance or the discussion around AI, for instance, isn't quite as exciting as people would hope for, and the stock could come under pressure.
Big tech bracing for the Nasdaq's special rebalancing. Chris Harvey of Wells Fargo writing, quote, the upcoming rebalancing is reducing concentration risk but creating uber cap selling pressure, with near-term liquidity demands likely weighing on the group. Let's get to the team coverage. Katie Greifeld and Mandeep Singh join us now for more. Katie, first to you. Talk to me about this rebalancing and what to expect over the next couple of days.
Well, it's special. It's out of cycle. And of course, this is designed to reduce the weight of those top 7 stocks in the Nasdaq 100 from a current combined weight of 55% to just under 44%. And it's scheduled to take place today in anticipation of Monday's opening. But today, in addition to it being a special rebalance, it's also option expiry day. So just to complicate matters further, we have about $2.4 trillion worth of options set to mature today. So usually that introduces some fireworks headed into the close. The fact that you also have this special rebalance on top of it, it could tick up volatility even further, of course, as money managers try to navigate that, try to bring their portfolios really in line with the new benchmark.
There's several risk events for the Nasdaq, including the earnings as well. Mandeep, next week, Alphabet and Microsoft on Tuesday, Meta on Wednesday, Amazon on Thursday. The week after that is Apple. For you and the team, Mandeep, which names are you focused on more than others?
I think right now the focus is definitely on the internet names, and notably Alphabet. Given, we have had a great run for all the other mega caps, Alphabet so far has somewhat missed out, and the ChatGPT overhang, you can see that on the stock. Based on the work that we have done, we've seen, YouTube trends are holding up very nicely. In fact, we think YouTube has taken share in terms of time spent on streaming platforms from the likes of Netflix. And cloud, look, I think you're going to see a benefit accrue to all the cloud vendors from AI, because there is that insatiable demand. And so I think both Microsoft and Google and Amazon are going to call out AI demand on their clouds.
Mandeep, yesterday we were drowning in news from Netflix, drowning in news from Tesla. There were some headlines around TSMC that hardly got any coverage whatsoever. I actually got a couple of messages about it over to Bloomberg. Mandeep, what was important about what happened with TSMC yesterday?
Yeah, so they called out their AI revenue, which is 6% of their overall revenue, but they expect 50% CAGR over the next 5 years. So I think, to put it in perspective, yes, the traditional CPUs and your traditional PC chips are still seeing weak demand. But when it comes to this new pocket of growth, even they call that out. So I think for a vendor like Apple, that may not sound very good, because obviously they are more exposed to smartphones, and that didn't seem to be that good for this quarter. But I do think for AI, I mean, NVIDIA and the likes, this is pointing to the demand, and this is going to hold.
Interesting. Mandeep, thank you. We'll catch up with you next week. Katie, thanks to you as well. The broader market fading a little bit here. 22 minutes into the session. We're still positive, but only just by 0.1% on the S&P 500. Let's lift the lid on this index and get you some sector price action. Here's Abby.
Well, John, let's take a look at the sectors here for the S&P 500, and we are going to see that on the day, earlier to your point, we did have broader gains, but similar to yesterday, we have some strength here from a composition standpoint, more sectors higher than not. That said, utilities, that's a defensive sector. That's the best sector on the day, so perhaps not the most bullish sign. But right below it, tech, and then on bottom, we have materials, financials, industrials, and energy. Interestingly enough, a couple of those sectors are actually the top sectors on the week. If we take a look at what's happening on the week for the S&P 500, we will see the energy up from sort of a stealth perspective, up 2.6%. Financials up 2.7%, as most of those big banks have reported, and many of the regionals. And then finally, consumer discretionary, well, that has everything to do, of course, with Netflix and Tesla yesterday, and communication services, similar deal.
Abby, thank you. Your trading diary up next. 25 minutes into the session this Friday morning. Good morning to you. Approaching 26. We're positive here by 0.2% on the S&P. On the Nasdaq, bouncing back from the biggest one-day loss since February. We're higher by 0.4%. That's the price action. Here's the trading diary. Coming up, going into the weekend and beyond. US PMIs and the Nasdaq's rebalancing taking effect on Monday. We get earnings from Alphabet and Microsoft on Tuesday. Meta results coming on Wednesday. Plus, we get a Fed rate decision and Chairman Powell news conference too. Full coverage, of course, here on Bloomberg TV and radio. An ECB rate decision coming up on Thursday, US GDP and Amazon earnings as well. And finally, rounding out the week with a BOJ rate decision and Exxon earnings on Friday from New York. That is it for me going into the weekend. Have a great one. Enjoy the rest of the trading day if you can. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, July 21st. Here are the top market stories we are following for you at this hour. OPEC's excitement, a $2.4 trillion options expiry today, plus the NASDAQ 100 special rebalancing could mean extra volatility. Steve Stosnick of Interactive Brokers would tell us what kind of fireworks to expect. Wheat whipsawed. Futures give back some of their weekly gain as Ukraine is preparing actions to continue the grain export deal. We'll bring you a conversation with the country's agriculture minister. And curve control, the yen drops as BOJ officials are said to see little need to act on the yield curve program for now. It's just one of a trio of big central banks on deck next week. From New York, I'm Kaylee Lyons, actually in Washington. Guy Johnson is in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, it's Friday. It's been quite a week. That isn't exactly over yet, but we arguably have an even bigger one coming for us next week.
Absolutely. There could be some fireworks at the close today, though. Look out for that. We'll speak to Steve Solznick about what is happening here in just a moment. But you're right, Kaylee. This week taught us that volatility can come back fairly quickly. Look at what happened with Netflix. Look at what happened with Tesla. Next week, we've got some really big central banks. ECB, does it get to 4%? Do we stop at 375? The market is now pricing, and Bernanke was talking about this, that maybe this is the last one from the Fed. And then there's the wild card of the BOJ. The Bloomberg reporting suggests that maybe nothing next week. But in some ways, they have to tell us nothing until they do something. And that raises the question about whether or not we could get a surprise. I think there's potential next week for a lot of pushback from central banks. It's going to be fascinating. I'm not going to be here, but I'm sure you're looking forward to it.
Guy gloating that he's going to be on vacation. I am looking forward to it because in addition to all of those central banks, we also have more large cap technology reporting. And we have seen, as you just mentioned, Guy, that has the potential to really swing the broader market in either direction. So it's going to be a big one. Plenty of room for surprises on both the macro and micro level.
I don't know why I took next week off. I have absolutely no idea. Anyway. I will be watching from a great distance. But our question of the day is a fairly straightforward one. Kelly's alluded to it. What is going to move the market most next week? The Fed? Is it going to be the ECB? Is it going to be the Bank of Japan? Let's kick this around. We've got Liz McCormick and Andy Curran to try and answer this question. Liz, what's the biggest surprise next week? Is it going to be the ECB? Is it going to be the Fed? Or could it just be the BOJ?
Well, before today, we all kind of, in my team, thought it might be the BOJ, right? There's a lot of speculation. Do they gonna pull back from the yield curve control or tweak it a little? But now, like you said, we had that great reporting from our folks overnight, and it looks like maybe not. So I was talking to James Athey at Aberdeen this morning, and we were saying it could be all three of them are no major surprises. So, but he said, you know, some risk for the ECB because after Governing Council member Knott came out seeming like a slightly more dovish than his usually hawkish self. So the market, if it comes off sounding more hawkish, there's a little risk there. But yeah, I think it's a wild card. Could end up being the Fed. We'll see.
Okay, so and if it's a toss-up, it's also a question of if the surprises are going to be more in the hawkish or dovish direction.
Well, I agree with Liz. Far and away the biggest potential for a surprise is the BOJ. If they were to move or even tweak, I can tell you there would not be a tradable security on this planet that wouldn't respond to what a BOJ does. And I've seen it over so many years when we had a BOJ surprise. When it was least expected, bang, they do something and markets absolutely rocket. But they're not expected to do anything. And I think the messaging has been fairly consistent that right now is not the time. So I think the boys probably will stay in the sidelines for now. Bigger focus will be on what the Fed and ECB signal for rate hikes.
Okay, I'm not going to let you go with just saying it could be next time, Ender. So let's talk about the impact that this could possibly have. I was listening to Andrew Bulls of PIMCO a little bit earlier on, talking to John Farrow. He was saying, this is widely telegraphed. We know at some point that yield curve control is going to be changed, tweaked. It is going to be altered. Why should the market respond to that? Derek Halpenny was on from MUFG yesterday. He says the initial knee-jerk reaction, you could get 40 basis points or more movement in US Treasuries. Is this one of those events that is that binary? You either get nothing or you get an absolutely massive response?
Yeah, well, I mean, if the Bourge was to move, then I think you would absolutely see that big ricochet effect. I mean, remember, the yield curve control program has had such an important anchoring effect in markets globally, and the BOJ's outsized influence in Japanese bond market, for example, all of these measures, if they were to signal that they are starting to change, they have been this outlier, as you know so well. They've been the big dovish one when the other major central banks have been hawkish. Obviously, that will have a profound impact. It comes down to maybe, what are they thinking about the yen's level at the moment? Ueda has been signaling he's not happy about triggering financial volatility in Japan's financial system. But the bigger focus still remains on the inflation story. They have new inflation forecasts coming in October, and I think that's why a lot of people are saying, hang on, maybe keep an eye out for a Halloween surprise rather than any kind of a midsummer blip.
Oh, so it could be spooky. Liz, when we talk about the inflation picture that the BOJ is going to be looking at, but what the Fed is looking at now as it gets set to meet next week and think about what it's going to do after that, the inflation data is trending in the right direction. But how confident are we in the Fed's confidence that that's a lasting pattern and that 2% is somewhat approachable?
Yeah, and the market is pricing that they get there, but I think the Fed, Chairman Powell, every time he can talk, seems to want to not give an inkling like we're, waving up the all clear, we've won sign, right? But he can't seem to, he keeps saying, our forecasts have signaled 2 more hikes, that would be this month and then another one thereafter. Market is not buying that, right? So the market's price for, next week is a lock, but only about 1 in 3 chance of another. So I don't know if he has it in him to kind of push back and be hawkish enough, right? Because I think the market and the data, everything is showing that maybe inflation has taken a turn for the worse. And you even see, the folks in D.C. in your area, the eco folks in Fed did a great story. Even some of the people who were so diehard we're having a recession are saying, maybe not, so we could have this immaculate disinflation and no recession.
Liz, there's a bunch of questions that come off this. A, if we don't get a recession, why should the Fed be cutting? The market's has got cuts priced in, so that's going to be a bit of a shock. And we still don't understand how much of the current tightening is working its way through the system and why inflation is currently falling. Now, inflation's not falling because of what is going on with rates, i.e. it's falling because of supply side changes, then the rate hit could be even greater. There's so much we don't know here. Why is the market so sanguine?
Right. There's so many variables. And I think you're right. The market is wants to rally, right? So which puts it at risk of something going wrong. What I've heard, Guy, as far as people saying, you're right. If we don't have a recession, why would the Fed need to cut ever? So, but the point is they're in restrictive territory, right? Eventually, even if there's no recession and they see inflation coming back closer to their target, it's just normal course that they would slowly, what they would call normalize. In a sense, the first cuts wouldn't even be easing, right, if they were still in restrictive territory. So some say that's why they see some cuts maybe in the second half, those folks who don't even see recession, because if inflation's back to target, the Fed may want to try to normalize policy. But you're right. I think the market is priced in too much if we have a soft landing. They're seeing below 4% on the funds rate by the end of the next year. I think, sadly, even though I follow markets and they're my thing, they've been wrong a lot. I will say, they were pricing in so much easing. So there might be some fine tuning, which could kind of upend those folks who are kind of wagering rates would fall fast. So there's a lot of risk there.
Yeah, and we've consistently heard, Enda, that they think the risk is still underdoing it, not overdoing it. Especially when we think about how there's multiple central banks next week, assuming the BOJ is not going to be one. Who is at greater risk of over-tightening? Is it the Fed or could it be the ECB?
It's a tricky one. Maybe the ECB, because so much of the pressures there have been unique to the energy story and not necessarily broad-based across the whole Eurozone economy. I mean, you hear Mario Draghi talking about, hang on a second, there's no labour shortage in Italy. We don't need interest rate hikes, for example. But that said, I think they're both on a fairly delicate path here. The problem is, I think most advanced economy central bankers would love to say, we think the inflation fever has broken, right? But they just can't be sure. They can't be sure, and that's why they have to keep signaling that kind of a hawkish thing, because they don't want the markets to run off and take over the narrative that the next move is going to be a rate cut rather than anything else. They need to be sure, and I think that's why both Powell and Lagarde will probably continue to manage that message that, look, let's get through the next few months. We're not there yet in inflation. We could still hike, but I'm sure under the bonnet they're probably saying they're hoping it's done, and that, yes, into next year maybe they can start easing.
Enda, one final quick question. If the BOJ moves, how does it complicate the story for the other central banks? I appreciate they're coming afterwards, the BOJ that is, so it's Fed, ECB, BOJ, but nevertheless, if you do get a surprise at the end of the week and you get a big move in treasuries, for instance, how does that muddy the waters for the Fed?
I think that would be the channel, right? It would be the financial markets channel that would flow over via exchange rates, via interest rates, and that would spill over into other corresponding markets. And the BOJ would be coming so late to the tightening cycle as well. But that said, guys, we're just talking about the ECB and Fed are so advanced in what they've been trying to do. I don't know if it would be necessarily a game changer for what they've been trying to do just yet, but it certainly would have an outsized impact on investor sentiment towards Japan.
All right, Liz McCormick and Enda Curran from Bloomberg, thank you so much. The three of us are going to be buckling up for next week while Guy just relaxes, but
doesn't.
That's okay. We'll be braced for it. We'll have more on our question of the day coming up next. What will move the markets the most next week? The Fed, the ECB, or the BOJ? We'll ask Steve Sosnick, Interactive Brokers Chief Strategist. This is Bloomberg.
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
You have a Fed now that is going to be looking at, we still have a very strong labor market, so the odds of them doing something in July are almost 100% at this point. And the question really is going to be, can companies continue to adapt and adjust and continue to keep their earnings where they are? And that is going to be the biggest question.
That was Sarah Hunt, Chief Market Strategist at Alpine Woods, earlier on Bloomberg TV. And with that, let's get back to our question of the day. What moves markets the most next week? Will it be the Fed? Or could it be the ECB or even the BOJ? Joining us now is Steve Sosnick, Interactive Brokers Chief Strategist. So Steve, we have to talk about what's going on this Friday as well, but as we look ahead to next week and three big central bank decisions that are coming down, what does options pricing indicate about what kind of activity we could see? What could potentially be the biggest surprise and catalyst?
Good morning, Kaylee. Right now, it's sort of a yawn. Options markets are sort of not particularly afraid of anything, as we can see by, VIX that's mired in the 13-14 range. And so, the BOJ took some of the uncertainty off the table, which is not to say that U.S. VIX traders or global VIX traders were that concerned about that anyway. The fixed income markets fixate on that much more carefully. Equities tend to react. So I do think that now, having the BOJ made its move, I think the Fed is number one on this parade, and I think that's where we're going to go. The question to me is, what is Powell's rhetoric, since the meeting seems to be a slam dunk for 25 basis points? The consensus seems to be for a dovish hike. What if he's not so dovish?
Yeah, I think that's got to be the risk. The risk is that he's definitely more hawkish. Steve, okay, so let's talk about other things. Let's talk about where other risks might emerge from. We've seen what happens when you disappoint on earnings this week with Tesla and Netflix. What are people setting up for next week? You've got a whole range of earnings coming through. We've got some big tech names going to be dropping. How are people positioned there?
Well, what we're starting to see now is I think yesterday was a wake-up call for a lot of people. We were not seeing a lot of risk aversion ahead of earnings in a lot of these big names. When I ran the numbers on Tesla, there was maybe a slight decline priced in, and even there it was pretty marginal. And then of course we were surprised with, call it a 10% drop. I think the better the performance, the higher the bar that the companies have to jump to get over the market expectations for earnings. Think of it this way. Netflix, Tesla, and TSM all beat on the top line. I'm sorry, all beat on their EPS, but then the market found something else to dislike. Whereas other stocks that had been kind of beaten up a little bit, the market didn't care. Think about Goldman Sachs's miss or Zions Bank going up 10% on some modest gains. So that's really, it's really about expectations right now, and I think that you're getting a little more nervousness coming into the stocks that have been high flyers.
Okay, so it becomes a question of just if we see isolated pain in the equity market to those that had performed the best up until this point, Steve. So could we see earnings actually be disruptive to the equity market at kind of the high level rather than sector specific, or is there enough to carry us through and keep us going even if we hit a speed bump?
That really depends on the rotation. If you get failures of the sort that we had in Tesla in some of the other, magnificent seven stocks, as I and others like to call them, there's a gravitational effect on those. They make up now, which is going to change a little bit after the close, but they make up right now 50% of NDX. Yep. They make up about a quarter of SPX, and that's not changing. So if you get some real hiccups there in some real market leaders, it has no choice but to bring the broader market down to some extent with it. We've been able to offset it with rotation. That is something that has been a new feature that had been absent for a while, and it's a positive. But let's start to hear, because some of the financials, like some of the consumer-based financials, American Express, Capital One, Discover, they're not telling a good story right now.
Can I just stay with this just for a second longer? I want to talk about the NASDAQ reweighting in a little bit more detail. But this point about earnings and what is happening with earnings and the market reaction we're getting to it, do we have, and you've been doing this a long time, do we have quite a big difference at the moment between what the market is expecting and what analysts are expecting?
For yes, and I will say, but that's directly proportional to the performance of the stock over the past few months. So the better the performer, the bigger the whisper number, or the higher the bar, whatever. Then when we go back and look at, let's say, regional banks, which have been kind of, been real underperformers this year, the market expectations have been beaten down sufficiently that it's easier to jump over it. So yeah, we are getting these big dispersions, Guy. That to me is one of the real concerns or tells or volatility inducers that we can get as we proceed through earnings season.
So Guy just mentioned, Steve, the NASDAQ rebalance, which we do have to talk about. How much do you think it could contribute to fireworks at the close today? What are you expecting? And then looking out over, the longer term, is this rebalance going to have the desired effect?
Well, let me break it into two parts, Kaylee, because they're both important. I think we will get some fireworks at the close today. To me, what was very interesting was that pretty much you could break down performance yesterday among the NASDAQ 100 by market cap, which was sort of the market realizing that you were going to have this rebalance today. Since they announced the rebalance, S&P and NDX have more or less moved in tandem until yesterday. Obviously, there were exogenous factors in NASDAQ. You would have expected some underperformance had people been selling into this. So I think whatever selling is going to occur is going to occur late today, and that coincides with expiration, which can always, muddle the picture considerably.
Steve, if you're a underperforming portfolio manager right now and you're behind on tech, is this going to be an opportunity to catch up?
I think it's a minor opportunity. I think if we sell off hard today, which I don't think we sell off all that hard into this because markets have gotten better at rebalancings, although this one is, kind of an odd one because it's so few stocks coming out. It could be a buying opportunity, certainly, but I think that, the bigger picture is not the rebalancing. The bigger picture is the earnings to come, and you still have these stocks maintaining very, very large percentages of NDX and SPX, and so that's going to be the much bigger factor.
Steve, always great to catch up. Thanks for stopping by to see us. We really appreciate it. Thanks very much. Steve Sosnick, Interactive Brokers Chief Strategist. Okay, still ahead, Britain's top antitrust enforcer telling Bloomberg that it could still block Microsoft's $69 billion takeover of Activision. More on that interview next. This is Bloomberg. (23:07) on the West Coast. Time to get to the startup. Top tech stories in the Bay Area and beyond. Very much beyond today. Silicon Valley starting its morning. One of the top stories, certainly, that the Bay Area is buzzing about right now is what is happening with Microsoft. Is the Activision Blizzard deal going to go through? We've obviously seen the court cases in the United States. We've seen the FTC being pushed back. You've also got maybe an equivocal CMA in the UK. We caught up with the CMA a little bit earlier on Bloomberg Television. Here's what the head of the CMA had to tell us about whether or not the UK regulatory authorities, which are currently pushing to block the deal, are being pushed around by some of the other regulators.
At the moment, our decision on prohibition stands. We investigated very thoroughly the deal. We found that there were serious concerns in relation to cloud gaming, and the proposals that were put forward by Microsoft at the time did not resolve our competition concerns. So Microsoft have indicated that they are considering how they might restructure the deal in a way that resolves our concerns. And really, as I say, it is up to them to come forward with a proposal that satisfies those concerns. And to be clear, it needs to satisfy those concerns fully and comprehensively. So a divestment may be one option, but it's really up to them to come forward with a proposal that meets our requirements. The CMA is committed to make sure that there are no competition concerns resulting from this transaction. That is our legal responsibility. That is our obligation in making sure that markets remain competitive. We will consider any proposals that are put to us, but those proposals need to meet those concerns in order to secure any way forward for the transaction.
So to be clear, it is still possible that the CMA doesn't approve any of Microsoft's proposals if it doesn't meet your qualifications.
It is.
That was CMA Chief Sarah Cardell with Bloomberg's Kriti Gupta and Danny Berger earlier. And Guy, this is really the remaining conundrum for Microsoft and Activision Blizzard as they try to close this $69 billion tie-up. We're good in the U.S. and in Europe. The U.K. remains the question. And remember, the deadline for closing this thing was supposed to be this week on July 18th. They've now given themselves till October 18th to try to come up with a solution that's going to satisfy the CMA.
I just wonder whether we are done in the US as well. Remember that there is obviously an appeal against that court ruling that pushed back on the FTC. So let's watch what happens with that one. And then I think there is this issue of the UK. There's this idea floating around that maybe what should happen here is that they should sell off or sell to somebody else Call of Duty. I just wonder whether the deal actually works if that were to be the case. So is there a less onerous remedy than what appears to be quite an extreme remedy to get this deal across the line? Maybe, but I don't think it's certain.
Yeah, that's really the question. Both companies say that they're still committed to getting this thing done for now, but would that change if it looks like they're going to have to make extreme changes to get it over the finish line? Something we will continue to keep an eye on for you. But coming up, something else we're keeping an eye on, interest rate risk and how that's affecting credit markets. Jajit Singh, Apollo partner and head of multi-credit investment strategy, is going to join us next to talk about that. This is Bloomberg. We are an hour into the U.S. trading session on this Friday, and at this time, it looks like we're heading back towards session lows. Bloomberg's Abigail Doolittle is tracking the moves. Abigail?
Yeah, Kelly, it is a bit of a wild day, even though those moves are small. Now, overnight, this is the S&P 500 E-mini futures. It looks like a little bit of a relief rally after yesterday's sell-off, and then on the open, not such a bad open at all, and then quickly almost flat up, and now we are actually lower. So to your point, we may see a bit of a decline here. It is, of course, options expiration day. That's the S&P 500, but we do have the special rebalance for the NASDAQ 100. So maybe we're going to see some bigger volatility. Again, it looks like volatility in that chart, but small moves. This on the week, though, this is where the action really is. Those two stocks that we were talking about yesterday, Netflix and Tesla, on the week, both down. The New York FANG Index, in fact, yesterday down almost 5%. Its worst day of the year. Right now heading to its worst week, I believe, since February. So this is the biggest degree of tech selling that we've seen this year. And you can see Meta, which reports next Wednesday, down 3.6%. The stock on the year up about 150%. Will the results justify that rally for both Netflix and Tesla? It seems like the answer is no. But we have one other factor. Let's take a look at the Bloomberg Dollar Index, because we did have the Bloomberg Dollar Index weak for quite some time. We now have it higher, up 4 days in a row, up 1.1%, the best stretch since either early March or February. This could really be a deterrent for stocks, as we talked about last week. Will the rally last? Well, let's take a look at a new chart that we have of the Bloomberg Dollar Index. Now, this is kind of an ugly range. You usually don't want to chart a range that's declining like this, but it is what it is. And it does appear as though the Bloomberg Dollar Index is likely to go back to its 50-day moving average, back to the top of the range. If that happens, we do, of course, Guy, have this week the Fed coming up. It might suggest that there's going to be something a little bit more hawkish or supportive there than folks had thought, or risk off on the week with big tech coming up. It's hard to know, but it does look like the Bloomberg Dollar Index could strengthen. If so, that could take another chunk out of stocks.
Has the buck stopped? It was our question earlier on this week. Or is the death of the dollar maybe over-exaggerated, if we're going to get all Mark Twain about it? Abigail, thank you very much indeed. Let us return to our question of the day. This week, we've certainly seen a few fireworks. Are we going to get more fireworks next week? Huge week for central bank, huge week for earnings. But let's stick with the central bank theme. You've got the Fed, then you've got the ECB, then you've got the BOJ on Friday. Jasjit Singh, Apollo partner and head of multi-credit investment strategy, joining us now. Jasjit, let me give you the option of trying to answer our question of the day. Do you think we're going to get fireworks? If we are going to get fireworks, which of those three central banks do you think could deliver them?
I think in the recent history, actually, if there is a week for fireworks, it's going to be next week. The VIX is all-time low right now, not all-time, but like recent lows of 13. So the expectations of the Fed moves, the ECB moves, and BOJ stance on yield curve control are pretty well priced in as of now. But I do feel that, more than just the move of the Federal Reserve by another 25 basis points and shifting higher, it's more like how the entire SOFR curve, entire yield curve will respond, and that might set off some kind of a reaction in the equity markets. The equity markets have been on fire. They've been recovering the losses of the last year. Some people call it the bear market rally, but it's well entrenched right now. But the give back, if there is any, it's going to be dependent on how the entire rate curve responds, and not just what the Fed does at the front end of the curve.
Well, Jasjit, isn't it also about how the entire tightening cycle ultimately transmits? Because there is this lagged effect that we're contending with. And I wonder, even though different asset classes may have gotten comfortable with the idea that the Fed is going to hike once more, but we're near the end, if we've really begun to reckon with the cumulative effect of that and how tight ultimately financial conditions are going to become.
Yeah, certainly. Like the financial, Fed has been raising for a year now, for more than a year now. And there is a lagged effect on the inflation, of course. Inflation has come down, it has been tamed, but still Fed doesn't want to take a chance and wants to raise even more. However, there is this common, and the yield curve reflects that, there is this perception that there is going to be a recessionary landing or some kind of a soft landing, because of which the Fed will turn around, and that's why you see the 4-year rate or 3-year rate a full 1 percentage point higher than today's, and a 1.25 percentage point lower than the move next week. So certainly the market has been wrong before. I think those expectations might be too aggressive that Fed will turn around and start cutting rates immediately.
Yeah.
And that relief rally which has taken place, there might be some give back on it.
Okay, so let's just explore that a little bit. I totally understand where you're coming from. Why would the Fed in some ways be cutting if we get a soft landing? The economy would be equilibrium. Maybe that would be the most desirable outcome. If that is the case, and maybe the Fed doesn't cut, and we've still got this cumulative effect that Kaylee is talking about, does it make sense that high yield spreads are as tight as they are right now?
I think locally at this point, the high yield spreads have tightened actually a bit too much, given the relief rally in the equity markets. They are under their historic mean, like the CDX index is trading below 400. That's always like a sign of where the pulse of the credit market is. And these highly levered companies are actually going to face problems because their cost of debt has gone up. The capital structures are still floating. They're not completely fixed, and the rates keep rising. Everybody has been banking on that, we're at the end of it, and now there'll be some give back, and the rates will start coming down, and therefore the market in anticipation has been rising. But yes, arguably, the credit spreads are tight right now.
So just to take that one step further, Jasjeet, what kind of default cycle are you expecting? How bad do you think ultimately it could get?
I think the default cycle will pick up. We don't expect it'll be a doomsday event, which we've seen in the past, like 2001, 2, or during Lehman. There are certain pockets, which will be under stress. Commercial property, for example. Even within commercial property, there are certain sectors like office and retail, etc., which are not doing as well compared to multifamily. So it's not pervasive, but it's pretty focused on certain sectors.
Do you think, and this is one of the key questions that I think we're going to be grappling with in the second half, do you think financing conditions for companies get easier in the second half? Or do you think they're as difficult as they are now? Because a number of companies are deferring, waiting, hoping that credit conditions are going to ease, that funding conditions are going to ease. Do you think that is actually going to be the case?
I think one of the huge detriments to those financing conditions were the events of SVB and FRC, like the smaller and middle tier banks and their balance sheets, and can they be in the market as lenders as they used to be? That's a huge question mark. However, the nominal economy, because of inflation, is still growing. The velocity of money is still there. The loans are always going to be there. It's just a question of would that affordability of that credit at that high of a level, whether it's 8% coupon or 7.5% coupon or 9% coupon for weaker companies, is that viable and consistent with the business model they're running?
All right, really great to get your insight on this Friday. Thank you so much for joining us, and enjoy the weekend. Jasjeet Singh, Apollo partner and head of multi-credit investment strategy. We appreciate your time. Coming up, though, we're going to turn from credit to the ag market. Wheat's record run this week is taking a pause for now. We'll look at Ukraine's efforts to revive the grain deal that Russia left earlier this week and the tensions ongoing in the Black Sea with the country's agriculture minister. And we'll have more on what it could mean for grains markets with Angie Setzer, founder of the grains market consultancy firm Consus. This is Bloomberg.
So Ukraine is taking steps to restart the grain export deal that Russia exited this week. Earlier, we spoke to the country's agriculture minister, Mykola Solsky, on how much Ukraine is currently actually able to export.
A lot of Ukrainian companies now export grain by trucks or by railways using territory of Romania and using infrastructure of Constanța port, as well as Danube River ports. So we have much less volume of export. I think at least 30% less than previous time. If we speak about capacity of destroyed ports, but some of these terminals had storage capacities few 100,000 tons of grain each, and they could load at least some of them 20 or 30,000 tons of grain per day.
That was the Ukraine agriculture minister speaking to us earlier. Meanwhile, continuing to think about how this implicates the markets, a wheat ETF is up with 3 days of inflows as Russia pulled back from this grain deal, and there is concern about the potential implications for prices of these crops. Joining us now is Angie Setzer, Consus founder and partner. Consus is a grains market consultancy firm. So Angie, you're the perfect person to speak to about this. How concerned really should we be about the price implications of what we are seeing in the Black Sea?
I mean, it's concerning no matter what. Anytime you see a reduction or a slowdown of flow of grain or anything that could potentially reduce the amount of grain available into the world, you see price implications and you see concerns that arise, and the prices have responded as a result.
Nevertheless, Angie, it does seem as if, given the very strong harvest that we're seeing elsewhere, given the strong exports that we're seeing elsewhere, that this time is different. Last time we saw concerns around Ukrainian wheat exports. We saw huge price volatility, real concern around the world about hunger. Just walk me through why this time feels so different to that.
We've made a lot of moves in order to facilitate movement out of Ukraine in ways that don't need to use the Black Sea and the Black Sea ports. And so we've seen the solidarity lanes come in to play in a big way. They've provided the ability to get that big backlog of grain. So one of the things that was very different, was timing. We were in the middle of the Ukrainian export season when the invasion happened in the first place, hence the 20 million metric ton of grain backlog that we had when the Black Sea Grain Initiative was originally announced. And so the amount of grain that needs to be moved is less out of Ukraine currently than what it was last February when everything happened originally. Secondarily, timing is different, and so with it being the middle of July here, we have about 6 weeks before the big flow of grain that needs to move out of the export terminals hits the market structure. And so we have a little bit of time here to get some negotiations underway and hopefully see these cooler heads prevail and work the situation out prior to harvest and the big flow of grain that is needed. In addition, world end users have been more prepared for this. This has been one of the things that we have seen coming to a certain extent. Russia has started and stopped the corridor, on and off, or threatened its future since November. And so a lot of physical grain traders around the world have been prepared a bit better by having extra stocks on hand. And in addition, we've had better production elsewhere. Brazil's getting ready to harvest a record corn crop. We're seeing improved production out of Australia and other places on wheat that they've really been able to step in. And so the increase in supply availability around the world and a better prepared world end user has made this hiccup a little bit easier to weather. But of course, we want to see the resolution sooner than later if possible, just to provide some more price stability and not create any type of further or any type of panic at all.
So if we think about kind of the other risks to the market and weather, I'm in Washington where it's been incredibly hot. In other parts of the U.S. Midwest and South, it's been incredibly hot. I know it's very hot in parts of Europe as well. How big of a threat is weather to the current harvest? And I would imagine that one is a much longer term one.
Yes, that's definitely something we're going to be watching for several months more, 6 months more, a year. I mean, weather is really the thing that we focus on the most when it comes to agricultural production potential. And as we move from La Nina to El Nino, the transition has been, a very harsh one. There are production concerns that remain in South America. El Nino can limit or slow the arrival of Brazil's monsoonal moisture, which will be absolutely vital to get the good start to their crop down there. We've seen heat and dry weather impact potential Chinese production. We've had conversations about the situation in the U.S. Weather is definitely the big thing. The geopolitical forces at play are huge factors as well, but we continue to watch weather very closely and hold our breath until the crop is in the bin.
Yeah, talking of the bin, I've always assumed that agricultural products have a very limited shelf life, Angie. Are we getting better at storing this stuff? And if so, are we getting better at evening out some of the differences in terms of yields, in terms of harvests, in terms of what is happening with issues around Ukraine, etc.? Are we getting better at managing this?
Yeah, I mean, here in the U.S., we have stored significant amounts of grain for months and years at a time. Grain, corn and wheat especially, if dried down properly and managed properly, temperatures, if they're kept cool and dry, they can store for years in the right location. And so that is one thing that we know. That is one thing that you're seeing, hundreds of millions, if not billions of dollars sent to Ukraine to help really kind of reinforce their infrastructure, get them to where they are set up to where if they can't move their grain through the Black Sea corridor, through these solidarity lanes, they can store it. And so we have the ability, that is one thing that is really important in this situation is that, if managed properly and if we have, the right oversight, we can store this for many months, if not years, this grain. We don't like to. We like to see it turned over. We like to see it keep moving. But it is something that's quite different than, say, a potato or an onion or something that would be more perishable.
Great stuff, Angie. Really useful insight. Thank you very much indeed for joining us on this such an important subject right now. Angie Seltzer, Consus, founder and partner. Thank you very much. Okay, coming up, we're going to move back to the banks. Big subject this week. Banks and tech basically have dominated the landscape. Wall Street's biggest banks done reporting their latest results. We've still got plenty of financials to work our way through. Next week, we shift our attention to the European banks. More on what is happening today and next week. The Wall Street Beat next. This is Bloomberg.
It's time now for Wall Street Beat, where we look at what is buzzing on Wall Street in the world of banking and finance. Of course, the biggest U.S. banks just wrapped up earnings for this week, and this morning we got American Express. Bloomberg's Sonali Basak is joining us now. So, Sonali, I know it's been a doozy of a few days for you. Give us the recap, this morning's results included.
Yeah, I want to focus on the regionals really quickly here, because you do have a day where you did see Regions Financial and Comerica both starting the day a little bit higher. Those gains have now reversed. You are looking at them lower on the day. It is interesting because you're looking at Comerica is one of the worst 5 performers on the KBW Bank Index this year. The worries here are around net interest margins in particular. You are seeing pressure on these two banks as well as on the industry at large, and that is even with net interest income rising. The gainer today, you are seeing American Express really also take a hit here. This is card spending growing. The reason we have American Express and Capital One neck to neck here is really interesting. American Express tends to have a consumer base that is wealthier, and therefore they have been expected to hold up very well through the storm that was expected in the market. However, you are seeing revenue rise less than expected, and therefore they are taking that hit to their stock price today as well. I will also point out that Capital One, the reason I want to point it out, we've been talking about it all week, has been the best performer in the KBW Bank Index, and they are also coming in a little bit better than expected here and maintaining their gains. And so really messy week all in all, but the thing that's good about this week here is that all in all you've seen a rise over the banking system overall, and the sense that we're out of the clear. So now it's really going to be a matter moving forward of watching just at what pace growth happens at, because the consensus here is that things are slowing down. So who's going to be impacted most by that?
Sonali, you're Wall Street, but Wall Street often provides a guide for what European banks are going to deliver. Is there a read across from what you've seen over the last few days? It kind of started this time a week ago, in terms of what we're going to see out of the European banks, trading, etc. What have you seen that we can find useful?
Yeah, there's a few things, because you have Banco Santander and UniCredit. I think the reason we watch the European banks is you've got so many regional differences, as well as the opportunity for those CEOs to step up and make changes at this time. UniCredit is on a 66